Good morning. This is Dan O'Brien with Kansas State University. Also here with Guy Allen, who's with IGP at Kansas State. We talked a little bit this morning about the energy markets, and especially the international energy markets, and a lot of events over the weekend. Big movement on the international stage. Guy, what's your take on it?
Yeah, some big news happening over the weekend is Russia and Saudi Arabia have, and with the other OPEC countries, have come to an agreement on oil production. They've agreed to the largest cut ever, agreeing to cut nearly 10% of their oil production. This agreement was sort of brokered by our President Donald Trump, and it should help to stabilize price. Now, this has been the largest cut since 2008, 4 times bigger than that particular cut. And I think that it's going to help stabilize things, but it's still not a sufficient cut in production to match what sort of demand destruction we've seen thus far in the wake of this COVID virus and the drop that we've seen in oil consumption from transportation. And with everybody locked up at home, like you and I are, we just haven't seen the demand for oil on that.
It looks like it's kind of two sides to the issue here, in that that the ills of the U.S. ethanol industry had to do with demand on the one side and the big drop in overall fuels. So maybe with this, you're at least dealing with half a part of the equation in terms of the overall gasoline market. But supply demand forces maybe raised things up a little bit, but still the shortness of the ability to have strong demand coming in is a big thing.
Yeah, no, that's exactly right. Ethanol is over a third of our corn consumption when you look at the balance sheet, which is quite significant. And to date, we've had about 30% of the ethanol plants shuttered. And today it looks like potentially you'll have a bit more shutdown on that. So if they get a little more certainty, even though prices are still pretty low, as of this afternoon, we've seen West Texas Intermediate close just below $23 a barrel, while Brent London crude is right around that $32 a barrel number. While it's not up much, at least it's stabilized, and we see at least a bit of more certainty in that market and take out some of that volatility that'll overflow to the potential demand we see, not only in ethanol for corn, but also in the biodiesel situation.
Well, and I understand, is it your understanding too that the break-even price for fracking oil supplies in the U.S. is somewhere around $40, $50 a barrel?
Yeah, the common number you hear is about $40 a barrel. I wouldn't be surprised if it was a little lower than that, but I think what the industry is looking for is a bit more certainty. So if you're running a plant, you can compare your variable cost to your total cost and decide where you want to run, and at least give you an opportunity to maybe run in the nearby spot market a bit, which will at least lend a little bit of support and at least take that volatility premium out of the market.
How about switching over? You and I have talked previously about the China and U.S. trade agreement and where things are at on that, and how soon we can expect to see some of that moving forward.
China continues to make strides in trying to meet their promises for that phase 1 agreement. We saw good purchases of corn and wheat last week. Soybeans we'll talk about in the next session a bit. But China is experiencing the same sort of difficulties through their supply chain, probably even a bit more so on the logistical side as they try to bring these ag commodities into their country. People need to show up for work. Their port operations actually need to be happening, and they're a bit frustrated on that. In addition, probably the biggest thing is the expected purchases of DDG as well as ethanol purchases by China just aren't going to happen in my view. They've seen the same sort of drop in demand for crude oil, gasoline, and energy consumption, probably even more so than we've seen here in the U.S. And that's not lending support to either crude oil as well as ethanol.
And if I could add in that China did come into the market and buy some corn about a week ago, but about 1/4 of it or so was in the current market year, and the rest was out there, which means they saw low corn prices and they bought. So they were buying to value, and just interesting how that will or won't fulfill their trade obligations to the U.S.
That's exactly right. Look at these low prices. We should be trying to buy in a lot of demand, but I think with the uncertainty we're seeing in the marketplace, it's just very, very difficult for people to reach out and make purchases even at these forward prices. That's why anything we can do to take some of that risk and volatility out of the market, like settling this Russian-Saudi thing, is a very, very big issue, which will drive across the whole set of commodity complexes.
Might finish up this first section and say that one commodity that Kansas is involved in that has benefited from this is grain sorghum. Suddenly, we've seen a jump now in grain sorghum exports, and most of that's going to China. So that's was the commodity that was probably hit worst and first by the U.S.-China trade discussions happened a while back, and now, thankfully for them, they're coming back online pretty quick. It's a good thing.
Yeah, no, well, without the production of ethanol, we don't have the production of DDGs. And the traditional buyers of DDG, both China as well as Mexico, will be switching back to grain, and particularly grain sorghum. I think it's got a big boost. So exactly right.
Good. Well, that's the end of this first segment. Thank you.